Hello, and welcome to Trader's Insight. Today is June 4th, 2015. I'm Samuel. I'm here with Matt.
Hey.
And Matt.
Hello.
Welcome to the show, Matt and Matt. We're back for another day. Today's been a bit interesting. We've seen huge losses in the markets today. Well, not huge. I mean, let's take a look at it.
Moderate pullbacks.
18 points. I mean, we're looking at 1%, which is normal.
I think it's under a normal move. I think that the normal move is
1%.
Around a 1.25 or 1.2%.
1.2%. Where would we see that?
16.43. Yeah, it's around 1.1%, something around there.
Yeah. So let's start out with talking about the IMF. Right. So you came across this story today, didn't you?
Yeah, and it didn't really surprise me. So, from what I read on Zero Hedge, actually, the IMF have revised.
Well, you're putting on your tinfoil hat.
The IMF revised the US growth forecast for 2015 down to 2.5% from 3.2%, and they advised the Fed not to raise rates or do anything until the start of 2016.
How do they really know those numbers, though?
I don't know.
Do you think they're just arbitrary? That they kind of like... Because it's kind of like GDP, right? Because I've read about how they calculate GDP, and there's definitely some magic that goes into it.
Absolutely. There's definitely magic that's been going to every single economic release that's come out in America for the past 2.5 to 3 years from the Fed. Because maybe what I'm thinking is that the Fed just completely balls up all the figures to make it look good, and the IMF actually look at the real figures, don't really pull them up on it, but say we'll come out of, not necessarily the truth, but come out of more realistic figures.
Possibly, but you would think with the IMF being a confederation of, or a global confederation of bankers, they'd be able to get some of their own information.
Yeah.
Who knows? But what's the important thing here?
Well, that rates aren't going to change.
I mean...
I think we all knew that anyway. I think anybody who's hoping for a rate hike this year was... wishing Christmas in September rather than December.
Well, when did we end QE? The last QE, QE4.
Oh, it was the end of last year.
Was it the end of last year? So we're looking at, here. And what have we seen? So
suppose yeah, it was there. It's the...
So right now we're looking at January, right? So that peak right there. So from...
Is this one back here?
No, that was October. That's October right there. So we looked at October, November, December they ended in, right? And we've just been kind of flat ever since then. I mean, how many points? We've gotten 40 more points in the SPY.
Yeah, I mean, now it's a realistic return for this year. I mean, if you look at the movement of the S&P over the past 2 years, and if you move that onto a weekly chart, and you look at the movement over the past 2 years, okay, you can see that the returns are above average. Okay, abnormally above average. Probably close. If you guys want to do the maths, I'm just ballparking it here. Probably closer to a 3 standard deviation move or even 4 standard deviation move.
Well, let's throw in a Keltner channel and check it out, right?
Sure.
So add a study. Studies Keltner starts with K. Keltner channels. Oof, wow, so it's been above a 3 standard deviation. Wait, no, that's 1.5 standard deviation. Let's change this to 3. Right. So let's check this out. So yeah, I mean, it's been touching as it's been going up with Q4.
Yeah, I mean, if you went back to 2010 and worked out the expected move over the next, for example, 3 years. Actually, no. Let's do that again. Let's say from 2012. Or let's say 2013, the start of 2013. What was the expected move over the next 2 years? It's going to be a 3 standard deviation move that they're in at the moment. I mean, all you have to do is look at the magnitude of what we are in at the moment. Compare that to 2000, and compare that to the 2003 through to 2007, 2008.
I mean, based on looking at this, it looks like we've been holding at the 3 standard deviation line for...
Well, that's what you call market manipulation for unjustified reasons by the Federal Reserve. These market crashes, people say that this bull market's going to go on forever, and it's not going to pull back. And even when it does, it's not going to be like 2000 or 2008.
Well, it may go on forever.
I mean, it may do. But where's the logic in that?
I mean, we have a Fed that wants it to go on forever. So it's it's interesting. I mean, What's the Fed so afraid of? Like, what's 25 basis points?
I think that the Fed is so. I think the Fed are in so deep that they can't get out. They can't get out.
Yeah.
And I think if they start trying to change things, whether or not the economy gets better, the markets will start reacting negatively to it, which I think needs to happen. I think they need to tweak and just play around with interest rates a bit. There's nothing wrong with increasing it by if a couple of basis points or whatever to see how the economy and how the markets react. Okay, now we saw in October of last year the market started to correct by 10%, and that bloody bollard from the Fed came out. And
it was not 10%; it was 9.5%.
Okay, 9.5%. And Bullard obviously got out of all of his put positions and said, okay, maybe we might be starting QE again. And then the market's rallied ever since then.
I've read some some books about the Fed during the 50s and the 60s and leading up to the 70s even, and before Greenspan came in. And even the chairman before Greenspan was still really quite a hawk when it came to interest rates, when it came to monetary easing, actually helping the economy. I was reading that now we have what's known as forward guidance. We have the Swami of Janet Yellen, who comes out to the people, announces what interest rates are going to be, and says they're looking at this, that, and the other for the future, right? And tries to give the markets at least something tries to calm the markets, pull them into complacency, so they keep on going up.
I have a question. I wonder how many call options combined the people within the Federal Reserve have on the S&P.
I wonder if they're hedging against their bonds with all these calls.
I'd like to see the net worth of every single individual in the Federal Reserve, starting from 2013, ending now.
Yeah. Well, what they used to do with the Fed, right, is instead of coming out and giving forward guidance, they just come out and said, rates are 2% higher. Done. Thank you. Markets adjust. So they would come out and they would set interest rates. People would have no idea about these interest rate hikes before they actually happen. And that uncertainty in the market created volatility, created a normal market where the unexpected was unexpected. And it's not just the unexpected is now expected.
But I mean, they'll be scared of doing anything really to instigate some sort of sell-off, because we saw how quickly this 9.5% correction happened. It happened over a series of 10 days.
Yeah.
Again, it had 3 to 4 straight days of 2% down days.
Yeah.
We're obviously so massively long, the stock market, and people are so fully invested into the market that the only place for the market to go is down if it's reverted back to its normal, its normality. So if the Fed actually tweak anything, maybe they're worried about some huge sell-off because people want a reason to get out.
No, but we were talking about this earlier in that most investors don't go short.
They don't.
They believe that going short is speculating, even though it's a viable strategy of investing, right?
Yeah.
But most people are just putting away $500,000, $2,000 a month, and they're not worried about they're going long every month, right? Yeah. And they need the markets to keep on rising up, and especially for people with mutual funds that are getting towards 60. We know the population of the United States is getting on in years. It's the same in Britain, it's the same in Europe, and for a lot of the developed nations in the entire world, especially in Japan. And seniors can't take a market going down. They need that fixed income coming in, especially with bonds, right? So bond levels have been incredibly low. Actually, let's switch over.
I mean, maybe before we do that, maybe it comes down to whoever's managing your money, because the amount of conversations I have with individuals who aren't very educated within the financial markets and investing, and they, it's the typical buy at the top, sell at the bottom mentality. And what I always try and get them to do is think about buying a house.
Yeah.
Okay, so let's say your house has a historical range of between 500,000 and 700,000.
Yeah.
Okay, where do you want to buy that house? You want to buy it at 500,000.
Yeah.
Not 700,000. So what difference does the financial markets have? It doesn't have any difference. Mm-hmm. You want to try and buy it as low as possible. Okay, so the logic of buying in this market now, okay, just waiting to be slaughtered, it doesn't make any sense to me. It'd be much better, like the people's portfolios that I, consult on and tell them what to invest in or invest for them myself. Over 50% of their money is in cash.
But that's not something that you could really recommend because, come on.
I think it's the most responsible thing to recommend. That the financial markets have gone too high, too quickly. Okay, it's not sustainable, and it's too risky. I would not be doing my job correctly. I would not be giving you responsible advice if I was to tell you to invest in a market at all-time highs.
Obviously, that's the contrarian play, but you're going to miss out. Right?
Sure.
Let's say people were saying this in 2014, 2013, 2012.
I mean, why not invest it in gold, or for example, or oil that recently crashed? Because 70-odd%.
Because the returns have been horrible.
Exactly, but people would buy a house that fell from 700,000 to 500,000.
Well, we're talking right, but we're talking about people that have had established positions for a while. Like if we take a look at the monthlies, like
So
let's say you had gotten into the market, right? Bought the indices, right? You come in, you just buy some like SPYs.
Yep. So you bought a house at 500,000. Yep.
Right. So let's pull up the SPYs. Where's the SPY? Why is it being so slow? So you come in, you buy some SPYs, right?
Yep.
And then you see it goes up. What? How much have we seen the market go up? 137%.
Something like that.
Yeah, so you get a 60% return in your house, and you listen to some guy who comes in and says, well, this is the top of the market, 2011, right? We get a little bit of a taper tantrum. There's some volatility, explodes, and you just sell everything. You start sitting on cash. You're going to miss another 70% of earnings over the next however many years. It's been 4 years.
Of course, but is that not then classed as outright gambling of investing in the unknown when we have such uncertain environments and circumstances? For me, I could never justify investing now, never, because it's too risky. I would much rather sit in cash or the majority of cash, diversify into something else, diversify into gold, diversify into oil or whatever the hell you want.
Yeah.
Okay, but maybe it's me. Okay, but going back to the analogy of a house, someone's bought it at 500,000. It's now sitting at 700,000.
Mm-hmm.
Okay, the likelihood of 9 out of 10 people would say they'd want to sell it and take that money and run.
Yeah.
And wait again to get in low again. And it's the same logic. And 80-year-olds, 90-year-olds, 70-year-olds, 20-year-olds, probably 15-year-olds. I guess that the market crashed in 2008, and that was 6-7 years ago. I'm 23 now. I was 15 at the time. It doesn't take a genius to work it out. It just takes some logic and just some simple explanation to somebody who isn't as good, as well educated as yourself to understand what's going on here.
Yeah. I mean, who knows if we're at the market top, right? But the only thing you can do until we do hit that top, and even as we go down, is just to be an opportunist about investing and speculating. And just be an opportunist and look for opportunities and try to find a place where you can buy into weakness and sell into strength.
Absolutely. I mean, do I buy stocks now? Of course I do.
Yeah.
Do I buy the S&P 500 outright? No, I do not.
No.
Do I buy the majority of stocks outright for a long-term investment? No, I do not. Did I buy Amazon yesterday for a 2 or 3 day play? Yes, I did.
Yeah.
But that's for a 2 or 3 day play.
Yeah.
So I'm not saying that there aren't stocks out there that are valuable. For example, Tesla. We went through the move yesterday that we caught on that. We went through EMC that's looking good. That's been hammered.
We haven't gotten to that yet.
We'll go through EMC in a minute.
We should go through Tesla as well too, because we didn't go through that yesterday.
Absolutely, yeah. It's just these examples of stocks that might be overvalued, but have been hammered, have declined over the past several months to a year.
Well, one thing that we really have to take a look at, and what we're seeing today, is in the VIX, right?
Yeah.
So,
I mean, my largest position at the moment is in the VIX, and that's not as a hedge. It's waiting for some sort of mean reversion. Now, someone can say...
Right, did you come in when it was at 12?
I came in when it was at 12, yeah. I mean, some people can say, the mean reversion isn't... It's at mean reversion now because that's been the average price. Okay, no. That's complete bullshit.
Let's take a look at the lows, right? Let's take a look at the lows going back.
I mean, if you take it back to a weekly, because this daily, all this is basically is manipulated shit from the Fed. So if you want to take an average price, let's take the low of 10.28 and the high of. Let's not even take the high of 31.06. Let's take the high of this one here. Let's take the high of 23. So the average is 17.18.
17.18, right? Yeah. And we can see that. Well, we need to get a moving average in it for a longer period of time, but we can see that it's probably in that 17-18 range. So when VIX comes down low enough to like 10, 11, 12, we know that it's suppressed, and we know that it's going to have to come back up. So I think maybe now we're about to see volatility start to move upwards a little bit. So let's go back to the dailies. Just in the past few days, just today, we saw a 10% increase. It's not a very good chart. Just today, we saw a 10% increase in volatility. So since May 22nd, which we saw lows of about 11.7, 11.8 for lows in the VIX, now we've seen highs of 15.55 or 15.50. So I mean, it's a pretty big move.
Yeah, it's a big move, and I think there's definitely more to come.
Yeah, definitely. I mean, we're looking. I mean, even if we look back, even if it's a moderate gain, we're looking at the VIX probably. Well, actually, we can't really do anything.
No, I mean, starting from this year when there was no QE, it's going to be a year without QE, or at least 7 to 8 months without QE. Yeah. God knows what the Fed comes up with next. We knew that returns weren't going to be as good as previous years because there's nothing there. There isn't as big of driving force that's driving the markets anymore. Okay, well, there's still zero interest rates, but there's no QE anymore.
Well, we know liquidity is drying up. That's one of the big things that we've found out this year is that through HFT and through the QE buying programs, there's not very many buyers.
It's because everyone's already in. Yeah. Everyone's all in. And what happens when everybody's into a market? It has nowhere to go but down. And if the market's still manipulated to go up when everybody's already in, then I mean,
especially with the bond market, because the bond market is incredibly larger than the stock market, right? And we're looking at when there's an 80 pip move in the bonds. A few days ago, it gets to a point where people have to close their positions just so they can fund their other positions.
Yeah,
and it creates this avalanche, this continuing waterfall of people having to get out and close their positions.
But hey, that's where
we make our money.
And it's about staying small in positions.
Exactly.
Sometimes we'll come into another time, but something when things like that happen to you, you have to question whether you were too big in a position. But whether it's 10%, whether it's 25% of your account, whether you have 10,000 or 10 million, it doesn't matter.
But if you have $1 billion in your account, trying to stay small is pretty tough.
Of course, yeah.
But you can do it though. So VIX has come up today. I'm hoping to push
it's what it's about, staying small and relative to your account size.
Yeah.
If you have $1 billion, you're not going to be making $10,000 trades. Okay, but you have $100,000, you may be putting 5% into a trade. $1 billion, you're going to be putting 5% of that into a trade.
So what can we do with VIX rising like this? Are we looking at? We wouldn't be buying. I mean, obviously, when VIX was low, we were buying calls, and we saw a pretty good profit from that today. Now that it's starting to get towards its highs, are we going to be selling puts in the SPYs or?
Yeah, I mean it could be. It's a mixture of selling puts actually in the VIX. The trade I did today was selling puts in the VIX and buying direct spreads in the VIX.
So let's take a look at the SPYs. Let me bring all these down. Let's go to maybe like 50. Right. So if we're going to be selling puts in the SPYs, what are we looking at? Where should we? We're going to be selling puts, right? Now that we saw the market come down.
I mean, I wouldn't be inclined to touch the SPY at all yet because I think there's still some more of a movement to come down. I think if we saw another day or two of weakness, it came up to some support level of strong buying, then selling puts would be a good decision.
Would it be good to sell some calls, or is that too risky with volatility? Expanding right now.
Yeah, well, obviously it's nice to do the contrarian play. So if we're talking about selling calls, we're going to be selling calls into strength, okay, and selling puts into weakness.
Selling puts in the weakness.
But I mean, there's no reason why you can't be selling calls now. It's just a bit of a riskier play.
Yeah, just looking for the bottom. Speaking of movement, let's actually go over and check out the euro, because I know that you made a big, kind of small big trade today.
Yeah, I mean, I took 60 pips out of the euro today. I mean, it's not a great deal, but that puts me on 260 for the week. And the euro US dollar is I trade very, very little, and I basically called the top of this. Whether it was luck or not, I don't know. But the euro is massively overextended to the upside. Whether it's going to go up in the medium term or long term, I don't care. It just has to come down a little bit.
So you're taking a look at RSI, and you're also looking at price movement as well.
Yeah, I basically looked at price movement. I basically looked at resistance, and I looked at multiple time frames. I looked at the daily, I looked at the 4 hour, the 2 hour, the 1 hour. And I just looked for some convergence in oversold levels. Saw some sellers come to the market, and took it.
Yeah.
So I mean, the way I see forex is more gambling. It's more kind of half-informed gambling, because there's no way.
Some people would argue with you.
Some people will argue all the time. Absolutely, which is fine. They can do it. So some people make billions on forex.
So let's take a look at some of the trades we've been looking at today. I think the big one which we were looking at was EMC.
Yeah. So if you stick it back onto a daily,
let's get back into daily.
I think we may have mentioned this before, but like we said, the way a lot of hedge funds or professional traders work is just exceptionally simple. As you can see, EMC has been on a downwards trend, as you can see from this descending trend line, and it's kind of formed a base, around this area here. And what it's done is come up and it's blown through this trend line, and that's usually quite a bullish sign that the downtrend is over. It's creating some good support underneath it. Buyers have now stepped into the market, and you should expect some sort of relief rally.
Sometimes.
So I mean, the play I did in this today is I bought two debit spreads. I bought the 27 and a half debit spread.
Let's take a look at that.
Yeah. With 16 days to go.
We've already got that.
15 days to go. So we already have that.
We were doing 26 and a half, right?
26 and a half, yeah.
So we had a few. So let's take this down to 10 strikes.
Yeah. So let's take a look. So let's show them what we did. So let's do the 26 and a half and 27 and a half.
Yeah. So we did the first trade that we did was a 26 and a half, 27 and a half.
Yeah.
Debit spread.
Now if we move it down to one contract.
Yeah, one contract. So we're getting 50 cents.
I mean, so it's over.
Well, I mean, now they're getting 50 cents. On the trade that we got, we're still looking at pretty good numbers as well, too.
Yeah, we're looking around 48, 49. It wasn't much difference.
Yeah, it wasn't much difference. So if we look at that, we're looking at $51 that would be our outlay, and
per contract.
Yeah, per contract. Max profit is $49, and we're risking 51.
And I mean, for me, that's absolutely perfect.
Yeah, that's great.
So I mean, the next one we did is we went out to the 43 days to go into the expiration, and the one I actually did then is I actually bought the 26 and sold the 30.
Oh, you legged it up quite a bit.
Yeah, I legged it up quite a bit just for previous examples of which we'll show you in a minute. I really like these trades because these stocks seem to have had a hard time over the past several months. And when buyers step in, they really, really step in and lift the stocks up.
So you've been making $1.18 out of on a $4 strike.
Yeah. So I mean, if you bring that down to a one strike again, one contract. Right. So we're looking at a $118 to make $282. Absolutely.
That's pretty good.
I mean, it's a good risk to reward ratio.
3-1.
Yeah, absolutely.
Yeah. So let's take a look at the chart. Let's see where it actually has to get to hit 30. So 30 is close to its previous highs.
Yeah, it's close to its previous highs. Now, that's more of a... I went much bigger size in the 26 and a half, 27 and a half. Again, let's use the analogy of you have 10 contracts. I would have used 8 contracts in the 26 and a half and 27 and a half, and use the final 2 contracts as some sort of lottery ticket for the 26 and a half and the 30.
Yeah, so we're looking at another 2% gain.
Yep.
For it to 27 and a half.
Yep.
The 28 is going to be about a 4% gain, and that 30 is going to be about a 10% gain that we're looking at. So just in case there's a big price movement.
Yeah, absolutely. And, if we relate this back to the Tesla trade, if you bring up the Tesla chart, we'll show you a trade, guys, that we actually did here live, if you draw the descending trend line again from the highs to the lows.
From here?
Yeah. Okay, you can see again what's happened here is Tesla's come down, it's tested this trend line, it's built up some support down the bottom, it's blown through this trend line and it's gone 40% up to the upside. That's a trade we took, we got out relatively early, but again it's a very similar setup.
Cool.
You can see it with Apple as well, which we did a couple of months ago. If you do Apple, we also did it here as well. We did it with this one. Down here. Okay, came down, built support around the bottom. It's kind of a reverse head and shoulders, blown through, and you can see how high that went. That went ridiculous high. It went up 30%.
Yep, really high. So that was our first trade that we made today. The next one was...
the next one was SPLS. It was an outright stock play.
This one is interesting.
It's interesting. Now, whether it's overvalued, I don't know. But in terms of the way I trade and my trading plan, this wasn't too bad of a stock for me for outright stock. And you can see it's made a good up move, and it's kind of consolidating along now. And I like that for higher prices. Yeah. Whether it's just a test of its high, I don't get into stocks and look for 100% returns or 50% returns. I look for just for 5, 10, 15% returns and get my money and run. Yeah.
So Stables has been trading pretty much. If we go back to say the first of the year, right?
Yeah.
We're looking at it's been trading within $1.
Yeah.
Pretty much, and that's hardly enough for an underlying like this.
Exactly, which tells me there's the way you can see here, it's built up support again around the bottom along here, and when I've been watching the tape, you can see a lot of buyers coming into this market and positioning themselves ready for some sort of move.
What are we looking at right here with this? It's just fat finger, right?
Yeah, it's just an outlier move. Whether it's whether it's a data error or what.
Cool. And then the last one that we were looking at today was what?
Maybe we could take a quick look.
Let's take a quick look at what did we lay on yesterday. Let's take a look at our monitor just so we can see this. Was it? It was. Right. So let's come back to we were talking about how the downward movement can indicate a price support being built and then the underlying moving up. So this is Oracle.
Exactly. So it's the same one with Oracle here, and you can see it's got the same pattern. It's got the descending trend line. It built support around the bottom, around the base. It broke through the trend line, and it's managed just to keep its head kind of above that trend line ever since. Now, one thing is for sure is that if you'd have bought calls on this, you would have lost some money by now just by the stock price staying as it is. I bought a bit of stock. I also actually bought some calls which I got out of, and I sold the majority of puts.
Yeah. So we were looking actually back here
when it first broke the trend line.
First broke the trend line back in April, and we were pretty excited about it. However, it's stayed in that relative range for almost a bit of 6 weeks now.
Yeah.
So we're looking for it to move. It's just going to have to. We're just going to have to draw a new trend line now, just like this.
Yeah.
And hope that it kind of keeps on.
Yeah,
pushing up through or
breaking through,
or even coming from down here. So just redraw that wedge pattern.
Yeah.
And just look for some price movement to get out from there.
Absolutely. And I think if we end it on the S&P again, if we go on /ES,
it's going to ES.
For some sort of outlook over tomorrow, I think we see some sort of snapback rally back to the mean before maybe some sort of sell-off.
Think we're getting to a sell-off?
Well, maybe some mild sell-off. Another day or 2 or 3 days of down days. I'm not talking about a big correction, but markets need to go down before they go back up.
Yeah, that's true. It'd be if we're drawing. We're still sticking to the trend lines. We have another few points that we can come down, right? Especially if we're looking at this. Yeah. So we're sticking on that lower trend line is looking pretty good. The higher one, I mean, obviously we could come down to 2078, which would be another 20 points down, which would be another normal expected move. So if we have another losing day tomorrow, obviously that's sticking to the trend line, but it'll be, we'll see what happens.
Yeah, let's see. I think it's at these levels in the market, it's about just being vigilant. It's about being small and nimble, and especially if you day traders, guys, get in, get out. We don't want to be taking on too much risk. We us guys here are all about staying small, all about reducing the cost basis, increasing our probability of success.
Exactly. All right, well, that's good for today. Thank you for catching up with us, and we'll be back tomorrow with another episode of Traders Insight. I'm Sam.
And I'm Matt.
See you later.
Have a good evening.